Treasuries are advancing as traders debate whether the Federal Reserve will cut by 25 basis points or 50 basis points at its September meeting. Here's what our guests on Yahoo Finance have had to say on the expected cut.
It's going to be 25 basis points in our view. I think it's going to be, there's not going to be any dissents. I think they're all going to be on the same page for the first cut.
Quite frankly, I wouldn't be at all surprised once people kind of crunch these numbers. If you get a little bit of a move back, talking about 50 basis points, given how benign this core PC is looking for the month of August.
And for everyone who's asking for a 50 basis point cut, I think they should really reconsider the amount of volatility that would cause in short-term funding markets. It's just not something the Fed wants to risk.
I think a 50 basis point cut would reek of panic, and it's almost like we're totally behind the curve at this point.
The Fed funds futures are right. The chances are is that it's going to be a 25 basis point cut.
They should go 50, but they're not. They'll go 25 because they're very cautious and they're very much incremental in the way they go about things.
Here with us now to break it all down is FedWatch Advisor, CEO and founder Ben Ammons. Ben, great to see you. Thanks so much for hopping on. All right, so, the size of the rate cut, that's getting debated as of this juncture, even though the CME FedWatch probability at one point this week was looking at about an 83 to 85% chance that, hey, yeah, it's just going to be 25, chalk that up, let's move forward. What do you think we could actually see? Is there still, is this still up in the air for a decision from the Fed, from your estimation?
Well, good morning, Brad. I think first, it's definitely not going to be an AI monster of Loch Ness type of a situation that you just described, because, it is the reality of like a Fed having to go down in rates for the first time, right, in a few years. And traditionally, they do that with a conservatism, making one step down with 25, as all your other guests are saying. But, for my own estimations is that the probability actually of a 50 is still over 50%. If you actually look further out, there's actually probabilities of around about 7 to 9% for a 75 basis point cut. And those are not, let's say, inconsequential, because if you're looking at the Fed funds rate and accounted for inflation, whether that's headline or core, the real Fed funds, as they say, has risen almost by 100 basis points since the start of the year. So yet we have priced a lot of rate cuts. So there's this big tightening coming in from the Fed passively that the Fed could take away over the next several meetings to support the economy. So technically speaking, Brad, they should be able to cut by 50, even at 75 basis points, just on that real Fed funds rate tightening. They're going to go for 25, as I think everybody's concluded, whereby I want to put one more nuance in there, that both Powell as well as Waller and even Bostic and others have indicated that there's an urgency on their part, right? They don't want to fall behind what they call the labor curve, meaning falling behind the curve that the unemployment rate goes up too fast, they can't control it. So I do think there will be a debate at this meeting that they should go for more if that were to be the case. So we're getting maybe a repeat of what we saw in 2022, where you start with 25 basis points and may have to go with more in subsequent meetings.
But Ben, what does that potentially then, does that pose a huge risk for the market if the Fed were to go 50 and make a larger cut or start front loading rates? And I bring that up just because we've talked to so many strategists and even economists over the last several days talking about the fact that risks may be signaling to the markets that the situation or the current economy is in much worse position than what is currently priced in. So if the Fed were to go 50, what does the messaging then need to be to Wall Street?
Yeah, generally people, Sienna, do take that as negative, as in, okay, so they are more worried than we thought they were, and therefore you get the negative reaction. And it may not be necessarily the information about the economy itself, because we all have the same information. It's just within the Fed, there's a sentiment like, well, we are behind the curve, we got to move faster, and that's that negative signaling. But and take the ECB from yesterday, by the way, they did the same thing, right? They didn't signal for October to be cutting again. And you saw the equity market reaction. It was actually rallying for that same reason, right? They're cautious, they don't have to go as fast. But as I mentioned, I do think there's a debate within the Fed from that other angle. We have already tightened with policy this year by 100 basis points in real terms. And how much is that really slowing the labor market down so that we're not falling behind if we just go too slow with rate cuts? So if they go for 50, it probably will be a very mixed reaction, if not slightly negative. But I do think that a lot of analysts will come down to this point that I'm making, is that this Fed has room to cut. And so it is actually not unnatural for them to do more because of the effect of real Fed funds on the labor market.
So if we were to see a more aggressive entry point in the cutting cycle, would that signal to you that we actually might be closer to recession than we think?
I actually think, Brad, it signals to me more that the Fed wants to get back to neutral quicker, and basically looking at like we are in a soft landing. In a soft landing economy, policy is supposed to be more neutral, not tightening, right? And I think that's, to me, what that signals, as opposed to this recession, because let's face it, like we don't have a recession scenario currently unfolding in any sort of way. All the data doesn't indicate the recession is right here, right now. So the Fed can lower rates. It's then more about how quick do you want to get to neutral. And this neutral rate seems to be estimated around 3%. So there's still some way down till there, right? But it's the idea of like the soft landing is secured by getting back to neutral. It's just a matter how quick. And if you don't want to fall behind the curve, you go quicker. So I think I'm still on the camp of that the Fed goes with 25, but really considers larger steps to be sure that they get the soft landing outcome.